Did you know that in just the last 6 months, the Federal Reserve has raised interest rates 5 times? Yes, 5 times. And what has been the result of all these hikes? Mortgage rates have soared past 7%. Credit card debt is getting more expensive by the day. And your savings accounts? They are barely offering any returns. In fact, the average American household now owes $16,000 in credit card debt, which is an all-time high. Add to that inflation that continues to rise, and suddenly, it feels like our hard-earned money is losing value faster than ever before. But here's the kicker: the worst might still be ahead of us. So, if you're feeling the squeeze and wondering what this means for your financial future, you're not alone. In today's video, we're going to break down exactly what's happening with these Federal Reserve rate hikes, how it's affecting your wallet, and, more importantly, how you can protect your finances in 2025. Let's start by understanding exactly what's going on with these interest rate hikes. The Federal Reserve, which is the central bank of the United States, controls something called the federal funds rate. This is the interest rate at which banks borrow money from each other. When the Fed raises this rate, it makes borrowing more expensive for banks, and ultimately, for consumers like you and me. The goal behind these rate hikes is simple: tame inflation. Inflation hit a 40-year high in 2022. Prices of everything, from food to gas to rent, were climbing at alarming rates. So, the Fed started raising interest rates to slow things down. The idea is that by making borrowing more expensive, people will spend less, businesses will borrow less, and the economy will cool down. But here's the problem. While this might help control inflation, these rate hikes are also having serious consequences for ordinary Americans. First, let's talk about mortgages. If you've been thinking about buying a house lately, or refinancing your existing mortgage, brace yourself. Mortgage rates are now hovering above 7%. And, just to put that in perspective, a few years ago, we were enjoying rates as low as 3%. Here's a real-life example. Imagine you're buying a $300,000 house. At a 3% mortgage rate, your monthly payment would be about $1,265. But now, with the current 7% rate, your monthly payment would jump to $1,996. That's a $731 increase every single month. For many people, that's the difference between being able to afford a house and being priced out entirely. And it's not just new buyers who are affected. Homeowners looking to move up, say from a smaller home to a bigger one, are also stuck. Why? Because selling their current home means taking on a new, much more expensive mortgage, thanks to these higher rates. But that's not all. The price of homes is still near historical highs, and it's not dropping just because interest rates are climbing. So, we're seeing fewer transactions, less competition, and overall slower growth in the housing market. Many people simply aren't able to buy homes right now. Next, let's talk about credit cards. If you've been carrying credit card debt, you're about to feel the sting even more. Interest rates on credit cards are directly tied to the Fed's rate hikes. As the Fed raises its rates, credit card companies follow suit, raising the April annual percentage rate on your balances. Right now, the average April on a credit card is over 20%, which is pretty high compared to just a few years ago. To put this into perspective, let's say you have $10,000 in credit card debt. With a 20% April, you'll end up paying $2,000 in interest alone in just 1 year, without even touching the principal balance. Here's the thing. Credit card debt is growing rapidly. The total amount of credit card debt in the US is now at an all-time high, over $1 trillion. And for many Americans, it's becoming harder to pay down that debt due to the rising interest rates. But that's not the only issue. Many people are now taking on more debt just to make ends meet. And as the Fed continues raising rates, that debt is becoming even harder to manage. If you've got student loans, this is also a crucial time to pay attention. While federal student loans are generally fixed-rate loans, many borrowers have private loans with variable rates, and those rates are going up. For example, if you have a $50,000 student loan with a variable rate, you might already be seeing your monthly payments increase. That's because private loan interest rates tend to track the Fed's moves. And with the Fed raising rates, borrowers with private loans are seeing their interest charges climb. With $1.7 trillion in total student loan debt in the US, millions of borrowers are already struggling to make their monthly payments. The higher rates aren't helping, and in fact, they're making the problem worse for those who are already living paycheck to paycheck. Now, you might think that savings accounts are the safe place to stash your money, especially when interest rates are rising. After all, higher rates should mean higher returns on your savings, right? Well, not exactly. While it's true that savings account rates have gone up slightly, they are still lagging behind inflation. The average savings account rate right now is around 0.5% to 1%. Meanwhile, inflation is running at 4% to 5%, meaning your money is actually losing value over time. For example, if you have $10,000 in a savings account earning 1% interest, you'd earn about $100 in interest over the course of a year. But with inflation at 4%, your $10,000 is losing $400 in purchasing power each year. That means you're not actually growing your wealth. You're just trying to keep up with the rising cost of living. Now that you understand the problem, let's talk about solutions. How can you protect your wealth in this rising interest rate environment? Number 1. Pay down debt as quickly as possible. The number one thing you can do is focus on paying down your high-interest debt, especially credit card debt. If you're only making minimum payments, you'll be stuck in a cycle of debt for years, paying off interest without ever touching the principal. Consider consolidating your credit card debt into a personal loan or looking into balance transfer cards that offer a lower interest rate for a limited time. The sooner you pay off high-interest debt, the better. Number 2. Refinance your mortgage, if possible. If you're a homeowner, now might be a good time to refinance your mortgage. Even though rates are higher, they may still be lower than your current rate. If you have an adjustable rate mortgage, ARM, refinancing to a fixed-rate mortgage can protect you from future rate hikes. If refinancing isn't an option for you, consider ways to pay down your mortgage faster, such as making extra payments or refinancing to a loan with a shorter term. Number 3. Diversify your investments. With interest rates rising, some traditional investments like bonds might not perform as well. This is a good time to take a closer look at diversifying your investments. Consider adding assets like stocks, real estate, or even cryptocurrencies into your portfolio. While these investments come with their own risks, a well-diversified portfolio can help you weather the storm of rising interest rates. Number 4. Build an emergency fund. If you haven't already, it's essential to build an emergency fund. This should be at least 3 to 6 months worth of expenses that you can tap into if something unexpected happens, like a job loss or medical emergency. Even though savings accounts aren't earning much interest right now, having cash on hand will give you peace of mind during uncertain times. And it will keep you from relying on credit cards or loans if an emergency arises. Number 5. Invest for the long term. While it's tempting to panic when the economy feels uncertain, it's important to think long term. Continue contributing to your retirement accounts, such as a 401k or IRA, and focus on building wealth slowly over time. If you keep your eyes on the long-term goal, you'll be able to ride out the ups and downs of the economy. The Federal Reserve's decision to raise interest rates is already making waves across the economy, and many people are feeling the pressure. From higher mortgage rates to rising credit card payments and the growing burden of student loans, the effects are widespread. But you don't have to sit back and accept the consequences. By paying down high-interest debt, refinancing mortgages, diversifying your investments, and building an emergency fund, you can protect your financial future and come out ahead, even in uncertain times. If you found this video helpful, make sure to hit the like button, subscribe to the channel, and turn on notifications so you never miss a new update. Drop a comment below. How are you preparing for the financial challenges ahead? I'd love to hear your thoughts. Thanks for watching, and I'll see you in the next one.